Welcome back to your SIE Exam Study course. Today, we are diving into debt securities and investment companies, two major parts of the financial world that you must understand for both the exam and your future career. Debt securities allow companies, municipalities, and governments to raise money without giving up ownership. Investment companies, on the other hand, allow individual investors to pool their resources and benefit from professional management. Let's start with debt securities by answering a basic question. What is a bond? A bond is a debt instrument. When you buy a bond, you are lending money to an issuer, whether that issuer is a corporation, a city government, or the United States Treasury. In return, the issuer promises to pay you periodic interest payments, known as the coupon, and to return your original investment, called the par value, when the bond reaches maturity. Bondholders are creditors, not owners. Unlike stockholders, bondholders do not receive voting rights and they do not share in the company's profits. However, if a company goes bankrupt, bondholders have priority over stockholders when it comes to being repaid. Now, let's go over the structure of a typical bond. Every bond has a few important features. The par value is the face amount of the bond, usually $1,000. The coupon rate is the annual interest rate paid to the bondholder based on the par value. For example, a 5% coupon means $50 in interest per year on a $1,000 bond. The maturity date is when the issuer is obligated to repay the par value to the bondholder. Bonds are often issued under a legal agreement called an indenture. The indenture spells out the terms of the bond, including any special protections for bondholders. A trustee, usually a bank, is appointed to act on behalf of the bondholders and ensure that the issuer lives up to its promises. Now, let's talk about bond pricing. Bonds can trade at different prices in the secondary market. They may trade at par, at a premium above par, or at a discount below par. The relationship between bond prices and interest rates is critical. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. Investors measure bond returns in several ways. The coupon rate is based on par value and shows the fixed annual payment. The current yield compares the annual interest to the bond's current market price. Yield to maturity considers not only the coupon payments, but also any gain or loss if the bond was bought at a discount or premium and held to maturity. Yield to call measures return, assuming the bond is called early by the issuer. Next, let's walk through types of bonds. First, corporate bonds are issued by companies. They offer higher yields than government bonds, but also come with higher risk. Corporate bonds can be secured, meaning they are backed by specific collateral like real estate or equipment. Examples include mortgage bonds and equipment trust certificates. Unsecured corporate bonds, called debentures, rely only on the company's promise to repay. Subordinated debentures are a special class that gets paid after regular debentures in a bankruptcy. Second, municipal bonds are issued by states, cities, and local governments. There are two main types. General obligation bonds, or GOs, are backed by the issuer's taxing authority. Revenue bonds are supported by revenues from specific projects, like toll roads or airports. One important feature of municipal bonds is that their interest is usually exempt from federal income tax and sometimes from state and local taxes, too. Third, U.S. government securities are issued by the United States Treasury. These include Treasury bills, or T-bills, which are short-term instruments sold at a discount and mature in 1 year or less. Treasury notes, or T-notes, have maturities between 2 and 10 years. Treasury bonds, or T-bonds, have maturities greater than 10 years. Treasuries are considered virtually free from default risk, although they are still subject to interest rate risk and inflation risk. There are also agency securities issued by government-sponsored enterprises like Fannie Mae and Freddie Mac. These securities may carry slightly more risk than treasuries, but offer higher yields. Now, shifting gears, let's discuss investment companies. An investment company pools money from many investors and invests that money on their behalf. The first type is a face amount certificate company, where an investor pays a lump sum today and receives a guaranteed amount at a set future date. These are rare today. The second type is a unit investment trust, or UIT. What is a fixed portfolio of securities, often bonds, with little or no active management. Investors buy redeemable units that can be sold back to the trust. The third and most important type is a management company. These are actively or passively managed funds and come in two varieties. Open-end management companies, better known as mutual funds, continuously issue new shares and redeem old ones. Shares are bought and sold directly with the fund, not traded between investors. Mutual fund shares are priced once per day based on the net asset value, or NAV, which is calculated by subtracting the fund's liabilities from its assets and dividing by the number of outstanding shares. Closed-end management companies issue a fixed number of shares during an initial offering. After that, the shares trade on secondary markets like stocks. Their prices fluctuate throughout the trading day based on supply and demand, sometimes trading above or below the NAV. When buying mutual fund shares, investors often pay a public offering price, or POP, which is the NAV plus any sales charge. Share classes affect how investors pay sales charges. Class A shares charge a front-end load when shares are purchased. Class B shares charge a back-end load if shares are sold within a certain time period. Class C shares generally have no front-end or back-end load but charge higher annual expenses. Breakpoints offer discounts on sales charges for larger investments. For the exam, know that investors can qualify for breakpoints by investing more money or by signing a letter of intent to invest additional funds over time. Now let's review risks associated with debt securities. Bonds carry several risks that investors must consider. Interest rate risk means that bond prices fall when interest rates rise. Credit risk is the risk that the issuer will default and fail to make payments. Inflation risk refers to the erosion of purchasing power if fixed payments lose value over time. Liquidity risk means some bonds may be difficult to sell quickly at a fair price. Call risk applies when bonds are callable. Issuers may redeem bonds early when interest rates fall, forcing investors to reinvest proceeds at lower rates. Mortgage-backed securities and some agency securities add prepayment risk, where underlying loans are paid off early, reducing future interest payments to investors. Here is a quick review. Bonds are debt instruments. Bondholders are creditors, not owners. Bond prices and interest rates move in opposite directions. Corporate bonds offer higher yields and more risk. Municipal bonds offer tax advantages. U.S. Treasuries are considered safe, but are still sensitive to inflation and interest rates. Investment companies help individual investors diversify. Mutual funds continuously issue and redeem shares at NAV, while closed-end funds trade like stocks. Risks associated with bonds include interest rate risk, credit risk, inflation risk, liquidity risk, and call risk. Understanding debt securities and pooled investment vehicles gives you the tools to understand both sides of a client's portfolio, how they invest for income, and how they diversify for safety. In our next unit, we will move into options and other investments, adding new tools to your growing financial toolkit. You're building serious momentum. Keep it going.